All right, if you're getting ready for the NMLS exam, I bet you've seen these letters, QM, HPML, HOEPA, and thought, what in the world is the difference? Well, you're not alone. Today, we're going to cut right through all that jargon. We're going to build a really clear map of these mortgage categories so you can see exactly how the risk and the rules stack up, one step at a time.
So let's start with a big question. Are all mortgages created equal? And the answer from federal law is a huge no. See, after the 2008 financial crisis, the government basically said never again. Regulators jumped in and built this tiered system. Think of it like a risk ladder for home loans. It's all designed to protect people from those really dangerous loan products. And look, understanding this isn't just about passing your exam. This is the bedrock of how modern lending actually works.
Okay, so where does it all start? At the very foundation of this whole system, you've got one simple but super powerful idea: the ability to repay rule. We call it ATR for short. This is the ground rule, the absolute starting point for pretty much every mortgage out there.
And the ATR rule? It's pretty much exactly what it sounds like. It forces lenders to do their homework. They have to make a real good faith effort to make sure that you, the borrower, can actually afford to pay back the loan. And this isn't some friendly suggestion, you know? It's a non-negotiable rule from the CFPB. If a lender tries to skip this step, they're in for some serious trouble. Think of it as the very first checkpoint for almost every single mortgage.
So, you might be asking, how does the lender actually prove they did their due diligence? Well, they have to verify these 8 specific factors. And we're not just talking about a quick peek at your credit score. No way. This is a full-on deep dive into your entire financial picture. They're looking at verified documents. We're talking tax returns, bank statements, the whole shebang. It's all about looking at everything, from your income to all your other debts, to make absolutely sure that new mortgage payment won't sink you.
Now, as you can imagine, documenting all 8 of those things for every single person who applies for a loan, that's a ton of work. So to make things a little easier, regulators came up with a kind of fast lane or safe harbor category, and that's what we call qualified mortgages, or QMs. Here's the deal. If a loan checks all the boxes to be a QM, it's basically given a golden ticket. It's automatically presumed to meet the ATR rule. This gives lenders a much clearer and frankly safer path to follow.
So what really separates a QM loan from a non-QM loan? It really boils down to one word: risk. QMs are designed to be the vanilla ice cream of mortgages. Stable, predictable, no crazy surprises. They're not allowed to have those risky features like negative amortization. I mean, can you imagine making payments every month and your loan balance actually goes up? Yeah, no thanks. Or those huge, scary balloon payments that are due at the end. QMs also have a loan term of 30 years or less, so they're built for one thing: steady, straightforward repayment.
Okay, get your highlighters out, because here's a number you absolutely have to know for the exam: 3%. For a loan to get that qualified mortgage stamp of approval, the points and fees the borrower pays generally can't be more than 3% of the total loan amount. Remember that number. It is a critical part of what makes a QM a QM.
Okay, so a loan can follow all the QM rules. But what if the interest rate is way, way higher than what most people are getting? Well, that's when we climb another rung on that risk ladder. We've just crossed the line into our next category: higher-priced mortgage loans, or HPMLs. Now let's be clear, these loans aren't illegal or anything, but because they cost more, they trigger a bunch of extra rules, all designed to give the borrower more protection.
So how do you know if a loan is an HPML? Well, the trigger is super specific. It's all based on how much the loan's APR, that's the annual percentage rate, goes over something called the average prime offer rate, or APOR. Just think of APOR as the daily average rate for good credit borrowers. For a standard first lien mortgage, if your APR is 1.5 percentage points or more over that APR benchmark, boom, it's an HPML. Now for bigger jumbo loans or a second mortgage, they give you a little more wiggle room, 2.5 or 3.5 points respectively.
All right, so once a loan gets that HPML label, a whole new set of safeguards kicks in automatically. First, the lender has to set up an escrow account for property taxes and insurance. Why? So the borrower doesn't get hit with a massive unexpected bill. Second, the appraisal process gets a lot stricter. And this is a big one. Lenders are completely forbidden from charging prepayment penalties. That gives the borrower the freedom to refinance into a better loan down the road without getting dinged with a huge fee.
And now we've reached the top of the ladder, the danger zone. This is the category that has regulators on high alert. we're talking about high-cost mortgages, which fall under a super important law called the Homeownership and Equity Protection Act, or HOPA. A loan gets this label only when its rates or its fees are so high that they trip the wires for the toughest, most serious consumer protections that exist.
So what does it take to get a loan flagged as high cost? Well, the first major trigger is the APR. If a regular first lien loan has an APR that is more than 6.5 percentage points higher than that APR benchmark we talked about, that's it. It's automatically a HOPA loan, no questions asked, and it has to follow all of HOPA's very strict rules.
But wait, there's a second way to trigger HOPA. It's not just about the rate, it's also about the fees. If the total points and fees on the loan are more than 5% of the loan amount, bam, it's also a high-cost HOPA loan. So, and this is really important to remember, it's an either-or situation. An excessively high APR or excessively high fees will land a loan in this category.
Because these loans are considered so risky, the law says you have to stop and give the borrower a special disclosure, and they have to get it at least 3 days before they sign anything. And let me tell you, the language on this thing is not subtle at all. It's designed to be a slap in the face. It's a final, "Are you sure you want to do this?" warning. It forces the borrower to look right at the potential consequences, like losing their home. HOPA doesn't just warn people, it takes a bunch of dangerous tools right out of the lender's toolbox. It flat out prohibits a whole list of predatory features. Prepayment penalties? Gone, always. Those giant balloon payments? Banned, with very few exceptions. Negative amortization? Not a chance. Lenders can't even jack up the interest rate if you happen to default. The whole point of these rules is to strip the most toxic, dangerous terms right out of the loan agreement.
And there's one final, crucial line of defense. Before a lender is legally allowed to close on a high-cost loan, they have to get proof. Proof that the borrower went and got counseling from a HUD-approved housing counselor. This is a huge deal. It means a neutral third-party expert has to sit down with the borrower, go over the loan terms, and talk about whether it's really a good idea for them.
Okay, wow, that was a lot. We've walked through ATR, QMs, HPMLs, and all the way up to HOPA. So let's pull it all together now and look at a simple cheat sheet that makes it all click.
See? This chart really lays it all out. As you move from left to right, from a safe, qualified mortgage over to a dangerous, high-cost HOPA loan, just look at how the rules and protections ramp up. You start with the basic safety features for a QM, then you add mandatory escrows and stricter appraisals for an HPML, and finally, you get to the most serious stuff like mandatory counseling and special warnings for HOPA. It's a ladder. Every step up in risk for the borrower means another layer of protection gets added by the law.
So listen, at the end of the day, memorizing these acronyms is fine for the test, but it's about so much more than that. This whole system is a framework built to protect people, to protect consumers. And as a mortgage loan originator, it's your job, your responsibility, to know this stuff inside and out so you can do your job ethically and legally. The real test isn't the one you'll take on a computer. It's using this knowledge every day to guide your clients into a loan that's right for them, one they can actually afford.